Welcome to part 4. In this video, we are going to talk about tax credits. And so tax credits can be beneficial for taxpayers because they reduce the taxpayer's tax liability dollar for dollar. And these tax credits fall into 3 types of categories that we're going to talk about in this video. So there are non-refundable personal credits, refundable personal credits, and business credits. And so the first one that we will talk about on this slide is the non-refundable personal credits. So the first example of a non-refundable personal credit is the child tax credit. And so information for this credit can be found on page 6 and 7 of your tax rates and schedules packet. And so for the child tax credit, the taxpayer gets $2,200 for each qualifying child under the age of 17 at the end of the year when that child is claimed as a taxpayer's dependent. And that piece is partially refundable. Then the taxpayer can also get $500 for each other qualifying dependent. And that piece is not refundable. And this credit is subject to a phase-out amount instead of a phase-out percentage. Next, there is the child and dependent care credit. So you can find more information about this credit on page 6 of your tax rates and schedules packet. And so what is defined as, or I guess what I should say is who is defined as a dependent for the child and dependent care credit is a dependent is anyone under the age of 13 or is someone who is disabled. The amount of the credit is based on the amount of the taxpayer's expenditures paid to provide care for one or more qualifying persons. And it is based on a percentage of qualifying expenditures. So the maximum qualifying expenditures is $3,000 for one qualifying person, and then $6,000 for 2 or more qualifying persons. And then the credit care percentage depends on the taxpayer's AGI. And that table for AGI is also on page 6 of our tax rates and schedules packet. The next credit is the American Opportunity Tax Credit. So details for this is on page 7 of the tax rate and schedules packet. And this credit is for the first 4 years of post-secondary education. It is for eligible higher education expenses in institutions only. And this tax credit is applied per student. So it can be for the taxpayer's dependents, and third parties on behalf of the taxpayer's dependents. And then for the credit, amounts paid by dependents are treated as paid by the taxpayer. And so the calculation for this credit, and we're going to have an example on the next couple of slides, it'll be 100% of the first $2,000 of eligible expenses, and then 25% of the next $2,000. So the maximum amount of credit that you can take is $2,500. It is phased out based on the taxpayer's AGI, and then 40% of the credit is refundable, subject to restrictions. And then the last credit we're going to talk about here is the lifetime learning credit. So this is also a credit related to higher education. This is also listed on page 7 of your tax rates and schedules packet. And so what this credit is for, it kind of explains it in the name. So lifetime learning credit. So if you decide to go to school after your bachelor's, for example, so the American Opportunity Tax Credit is for the first 4 years. So that would be like a bachelor's degree. If you decide to pursue an even higher degree than that, or if you just really like school and continue to keep going so you can learn new things, then the lifetime learning credit is more applicable for you. And so eligible expenses for this credit include tuition for any course of instruction to acquire or improve a taxpayer's job skills. So, like we'd mentioned, it includes professional or graduate school, and it includes any continuing education. And so this credit is applied per taxpayer. And so for this credit, if a taxpayer is married filing jointly, that is considered as one taxpayer. And so the calculation for this credit is 20% of up to $10,000 of eligible expenses. So the maximum amount that you can take is $2,000. And this credit is also phased out based on AGI. So for our American Opportunity Tax Credit example, so there's going to be 2 parts to this problem. For the first part, Courtney paid $2,000 of tuition and $300 for books for Ellen to attend the University of Missouri, Kansas City during the summer following the end of her first year. What is the maximum American Opportunity Tax Credit before the phase out that Courtney may claim for these expenses? So the answer here is $2,075. And the way we calculate that is because the cost of tuition and books are eligible expenses, so the total amount that was spent, if we recall from the previous slide, the tuition was $2,000, and then the books was $300. So the total amount spent is $2,300. And so when we go through the credit calculation, 100% is applied to the first $2,000. And then the remaining piece above that $2,000 is multiplied by 25%. So 2,300 minus 2,000, that gets us $300 times 25%. And so then that gets us the $75 part of the $2,075 that can be taken. So part 2, how much AOTC would Courtney have been allowed to claim on her 2025 tax return if she were married and filed a joint return with her husband, assuming the couple's AGI is $162,000. So the way we would calculate this is first, we would pull in the AOTC amount before the phase out. So we calculated that in the previous slide as $2,075. Then we will want to take our AGI and compare it to the phase out threshold. So our AGI in the problem told us was the phase out threshold is $160,000. And so then our excess AGI is $2,000. Then we will want to find our phase out range for a married taxpayer filing jointly. And so that phase out range is 180,000 minus 160,000. And I pulled this from page 7 of our tax rates and schedules packet. And so under the American Opportunity Tax Credit, it's the 4th bullet where it says the phase out is pro rata for taxpayers with AGI between 160 and 180,000 for married filing jointly. So then when we subtract those two, that makes our phase out range of 20,000. Then our phase out percentage, the way we would calculate that. So our phase out percentage is the excess AGI of $2,000 divided by the phase out range for our filing status, which is $20,000. And that gets us 10%. Then to calculate the phase out amount, so I'm gonna come back up here so I have a little more space. Our phase out amount is we wanna take our AOTC before the phase out, so we calculated that as 2,075. And then we multiply that by our phase out percentage. So if we multiply this by 10%, that will get us, and we're gonna round it to the nearest whole dollar. That gets us as our phase out amount. And then the AOTC after phase out equals 1,867. And so that's taking that 2,075 minus $208. The next set of credits that we're going to talk about are refundable personal credits. So there are a few different types, such as the refundable portion of the American Opportunity Tax Credit. There are refundable portions of the child tax credit that we previously mentioned. There are refundable personal credits for any excess FICA withholdings. But probably the most common and prominent credit under this category is the earned income credit. And so the earned income credit is discussed on pages 7 and 8 of your tax rates and schedules packet. And so what this credit is for, or why it exists, is it is designed to help offset the effects of employment taxes on compensation paid to low income taxpayers, because those employment taxes that we get taken out of our checks, if your income is low, that's a pretty big percentage of your pay that is being subject to taxes. And so this earned income credit also encourages lower income taxpayers to seek employment. And so because this credit is refundable, it is sometimes referred to as a negative income tax. And this earned income credit, in order to be eligible for it, you must have earned income and you must have at least one qualifying child, or you have to satisfy certain age requirements and you cannot be the dependent of another taxpayer. And so the amount of credit that you are allowed to take depends on your filing status, the number of qualifying children who live with you or the taxpayer for more than half of the year, and the amount of the taxpayer's earned income. The last category of credits that we are going to talk about in this video is the business tax credits. So these credits exist to promote certain types of behaviors for businesses. So for instance, there is a research and development credit that encourages businesses to spend money to develop new technology or research new ideas. Business tax credits are non-refundable credits. However, if the credit exceeds the gross tax for the year, then the credit can be carried back 1 year and carried forward 20 years. Another credit that we want to talk about here, because it's kind of a hybrid business credit, and the reason why it's hybrid is because it's kind of a business credit and it's kind of a personal credit. And it is the foreign tax credit. So this foreign tax credit is non-refundable. It can be carried back 1 year and carried forward up to 10 years. And what this credit does is it helps reduce the double taxation that a taxpayer may face whenever they pay income taxes on their foreign earned income. So let's say someone was working for a company. They originated from the United States, but they're working in Germany now. They may have to pay taxes to Germany on their earned income and to the United States. And this foreign tax credit tries to essentially reduce that double taxation. The last topic that we want to talk about with tax credits is the order in which the credits are applied to a taxpayer, because the order does matter. when looking at our tax credits, our non-refundable personal credits are applied first, then our business credits, and then our refundable personal credits. And so the reason why non-refundable personal and business go first, or so in that order, non-refundable personal and then business, is because those credits can reduce a taxpayer's gross tax to zero, but it can't go below zero. So that's why those are applied sequentially first. Then the refundable credits can reduce a taxpayer's gross tax below zero. And then that excess refundable credit is what creates a refund for the taxpayer. And so then when those credits are applied, so the non-refundable personal, since that cannot reduce a taxpayer's gross tax below zero, any excess credit is lost for the non-refundable personal. For the business credits, those also cannot reduce the gross tax below zero. So then if there is an excess business credit, those can be carried back and carried over. Then for the refundable personal credits, since those can reduce the gross tax below zero, because then that's what creates a refund. That's why they're called the refundable personal tax credits. Any excess credit gets refunded to the taxpayer. This ends part 4, and I will see you in part 5 to wrap up chapter 8.